How's it, guys? Thanks for tuning in. Today I'm going to discuss the ICT 15-minute strategy with the 2022 ICT mentorship entering criteria, focusing on the following: the fair value gap, the optimal trade entry, the OTE, the premium versus discount market, and the silver bullet as entry confirmation used in Confluence, right? Before I go into details, first of all, I want to emphasize that this model does not necessarily require you to know the daily or weekly directional bias of the market, but it is crucial and advantageous if you know the weekly and daily market direction, right? What we are going to do is on the 15 minutes time frame, on the 15 minutes time frame as the biggest time frame, because this is a 15-minute strategy. The 15 minutes time frame is your biggest time frame because we are going to use the 1 minute time frame to get your entries, right? What you do on the 15 minutes time frame is you look for for liquidity points and or PD arrays in the form of swing points, both sell side and buy side liquidity, labeling them as such. Okay, first of all, let's look for 8:30 in the morning. Where is 8:30 in the morning? 8:30 is around this candle. This is our 8:30 candle morning, right? This is around in the morning. Then we have to look for our range. This is our range. We have this high, it's our range, and we have this low. This is our range. Now what we do is 8:30. Now we look for, in this range. We look for the first swing high and the first swing low prior to 8:30. Where is our first swing low? This is our swing low. This is our swing low. And this is our first swing high. Our first swing high is here, so we can use this one because they are too close to each other. We can use this one. Let's label them accordingly. This is our buy side liquidity of the range. This is our buy side liquidity. It's BSL is buy side liquidity, as you can see. This is our sell side liquidity, and this is our sell side liquidity in of the range. So now we have this. The gist of this strategy is before 8:30, you identify the sell side liquidity and the buy side liquidity. So whichever one is patched first, whichever liquidity is swept first, you look for trade in the opposite direction. But let's take a deep dive into that and see what we can find. We have this range. This range was created from here to here, but it broke structure to the upside here. So we have this break of structure. We have this break of structure. A break of structure to the upside tells us that the market is changing direction and the market is going bullish. Now we have a bullish market, but the market cannot just continue bullish because the market moves in impulse, impulse, and correction, impulse, correction, impulse, retracement. So now the this break of structure occurred. Now we have to look for a retracement. Where is the retracement going? We can look for a fair value gap or an order block. We have a fair value gap here. We have a fair value gap here. And because of this break of structure here, we have an order block. This is our order block. We have an order block here. An order block which is a series of candles. We have our order block here. We have our order block here. These series of candles are all considered order blocks because it's from here to here. We have down candle which are responsible for the break of this low. Right now we are confident the market is going bullish. Okay, let's delve into this price here. Here we have the market. After the market made this high, the market started retracing because the market is going to a discount. I forgot to say that. If you can check here, this is anything from this above this 0.05 is premium, and anything below is discount. So we are looking for a PDRA in a discounted market, so that a discounted market start here, but we cannot use zero because we have this PDRA in form of an order block and the fair value gap here, right? So we look for the market to go here. The market make this high, it broke structure to the downside, made this high, failed to make a lower low, and it made a lower high, and it make the market made this relative equal highs. This relative equal highs here. We have relative equal highs here. So this is we know that there's liquidity. So at 8:30, the market shoot up. Then it made a higher high. It made a higher high here by breaking this buy side liquidity. When we break this buy side liquidity, we know that we have to sell into the order block or the fair value gap in order for the market to go up. We have to sell into the fair value gap. So now we're looking for sell opportunity because the buy side liquidity has been patched. Let's go to the 1 minute. On the 1 minute, the buy side liquidity was patched here. Now, as we are looking for buy, where do we buy? We wait for the market to create a swing low, then then break that swing low with a fair value gap. The market didn't create. The market created this swing low, because the candle on the left is higher and the candle on the right is higher, and we have a candle breaking that swing high, that swing low. I mean, here we have a fair value gap. Right? Unfortunately, in this example, the market didn't retrace into the fair value gap and give us a sell opportunity. Instead, the market just sold off. Then it created equal lows here. The market consolidated. Then it tapped into the order block and the fair value gap. Right. So as soon as it taps into this fair value gap and the order block, we know that we are looking for a change of direction for the market to buy. Right. Then what do we have? We have this break of structure to the upside. This because the market broke structure to the upside first. Anything below here is gonna be a liquidity sweep like this one. This we have this as relative equal lows, and this is a liquidity sweep because this break of structure tells us that the market wants to go up, but before it goes up, it has to clear liquidity to the downside. So it breaks structure, then comes back and do a liquidity sweep. Then we have another break of structure here. We have another break of structure here. This is confirmation that the market is going up. Same thing for the same thing that happens here. Wait for the market to create a swing low. Here it's opposite. We wait for the market to create a swing high and break that swing high. So you have a swing high here, and the swing high was broken here. And from the displacement low to the displacement high, we look for a fair value gap in between. Where do we find the fair value gap? We find the fair value gap here. Here's the fair value gap. That's where we get our entry. Our fair value gap. That's where we get our entry here. Let's see if it's in the discounted market. The fair value gap is in a discounted market because if you check here, 0.5 is here and the fair value gap is here in the discounted market. So it's safe to buy. So what you do is you place your long position at the 50% of the fair value gap, but this fair value gap is relatively small, so you can use the open. It's fine. But for refinement, use the 50% of the fair value gap. Just put your stop loss just a couple of points below this swing low, and you target where you target this this fair value gap. Why? Because the market has a potential to come here and sell off into the 50% of the fair value gap, of the 15 minutes fair value gap. So that's why that for you to be safe, target the open of the fair value gap. So when the market came here, you can see this. This fair value gap was not respected. How do we know that the fair value gap was not respected? The fair value gap was not respected because if the fair value gap is respected, these candle marks are not supposed to close above this fair value gap. So whenever they close above this fair value gap, we know this fair value gap has been invalidated and we get a break of market structure again. We get a break of market structure again, confirming that we can still expect more bullish movement. So what do we do? Because of this break of structure to the downside, we have this break of structure to the downside. I mean to the upside. Sorry for that. To the upside. Then we know that the market has a potential to retrace anywhere in a discounted market from here to here. Let's see where the discounted market is. We start from here because this is where the impulse started. We don't start from here. We start from here. Then the fib here. So this is our 50%. Then this is our discounted price. Where do you see a fair value gap in a discounted price? We have two. We have one and we have two. This is our fair value gap. Let me remove this. We have two. So we have two. Then we look for position to go long again. Why are we going long? Because we have to find where is that? Because this the 15 minutes range is liquidity. The 15 minutes range is liquidity. The 15 minutes range is our liquidity point. So what we do is now you wait for the market to retrace back into one of these. You can take your long position again at the 50% of the fair value gap. Then where do you target? You target this and you put your stop loss just below this, just below this. But you can target higher liquidity points. But what I like to do is I like to target here this as my first, as my second partial, because I'm going to take partials here. This is going to be my first partials. When the market breaks this high, I take partial. So the market retraces back into here, then it buys. Then when it breaks this, I take my first partial and I move my stop loss to break even. Now whatever happened to the position, I know that I'm protected. Now I can move the take profit a little bit higher, depending on the 15 minutes buy side and sell side liquidity. That's where I'm gonna put my take profit. So when the market comes here again, I take partials again and I move my stop loss from break even up to here. This is going to be where I put my stop loss now. My stop loss here because the market broke this high. Now I'm going to keep on doing that until the market breaks. Like for example, when the market is here, then my stop loss will be above this liquidity high. When the market when the market start breaking, when the market is here, my stop loss will be here. This is where my stop loss will be. I keep on trailing my stop loss until I get taken out by this candle. So this is essentially the entire trade here, from the stop loss here, right? Let's look at No, I was supposed to say let's look at the silver bullet, how the silver bullet played out, but I think I can create a separate video for that. So until we meet again next time, take care, guys.